Everyone, welcome back. Thank you so much for joining us. We have the pleasure of speaking again with the CEO of TappAlpha. We had him here when he first launched. I believe your daughter was just born. This is like a little over 6 months ago. You came on, and it was TSPY, right? We're still doing that. Hit the market August 16th, 2024. And we last talked, you guys are doing 4.2 million under management at the time. Now you guys are up to 22.3 million. It's a 5x in growth in 6 months. Tell me what's going on.
Yeah, thank you so much for having me. It's crazy to look back and say it's been 6 months since we chatted and just all of the experiences that we've had since then. But what a time to be in the market. But yeah, to your point, so yeah, 0 to 25 million in 6.5 months, which was, we were really excited about it. And I think a lot of it's driven by, the audiences that sort of watch your channels, the retail folks that are really interested and actually understand really well income strategies, covered call strategies, 0 day strategies. And so that's really what drove us, I think, to get the initial traction that we got. And then the other interesting thing too is as we've kind of grown talking about T-Spine and what it does, advisors have become really interested in it too because of the potential tax efficiencies, how it can be a complement to a S&P 500 holding. Oh, it's S&P 500 plus an income component that can actually deliver tax efficient income potentially. So I think those things put together, especially now where markets are really volatile, have sort of added to the interest in these types of strategies. And so we're just really excited to have 6 months of track record behind us, and then all the things that we've learned over those 6 months, modified, iterated, and hopefully getting stronger and stronger with every lesson that we learn. So great to be back with you.
Thank you. Thank you. I know personally for me, I had started off, as a retail investor because I have no, you know, professional educational background in the fund. Like I didn't go to Wharton, that wasn't a thing for me. So I had started off like everyone else. Like, what do you buy the index, you buy the Vanguard, and then after the 2020 dip, I was like, there has to be a better way. And I started getting more into the income ETF space. And I'm just like, this makes more sense to me. Why speculate that in 30 years that, maybe I have a Vanguard portfolio worth 10 million and I'll be able to offload that onto someone who's willing to pay me 10 million. Instead, I started getting into like, why ride this crazy roller coaster when I can get income now? Slowly compound it, build it. That just made more sense to me. Is that what you're finding?
What's been amazing is retail investors are so savvy and so smart, and they understand the underlying tools. And that I think is the biggest change condition over the last decade or 2 decades is, you don't need that Ivy League education. There's resources that can actually help you learn this stuff. And I think your channel is a great resource for folks to do so. But it's exactly that. And then you think about these strategies, it's a roller coaster. But what's interesting about option-based strategies is options are a tool to harness that volatility and turn it into income. So if you apply it right, these markets like the volatility we're dealing with right now in April of 2025, it creates a really interesting moment to leverage strategies that are using tools like options because it gives you a way to harvest that volatility and turn it into something valuable. So the timing is really good. And this is certainly a unique time with what we're seeing in the marketplace right now. The change that happened from January to now is pretty remarkable with the drawdown that we've seen. But one of the things that we're working really hard to do is like, yeah, the equity and the capital growth of the underlyings are tracking the market and you're seeing drawdowns. But our goal is to still deliver consistent income to sort of smooth out that experience over time.
Yeah.
And that's a balance that a lot of retail folks and advisors actually really like, especially in markets like we're seeing today.
I did track the dividends. You guys paid consecutively every month without fail between 27 cents to 29 cents with a 98% return of capital. Is that what we can expect for 2025 as well?
Hard to predict the future because no crystal ball, right? So the markets could be, come back in a big way, and then that has a tax impact too. But I can share like our 2024 when the markets were kind of going up, our classification for distributions was 17% qualified dividend because we're actually distributing the SPY dividend directly, and then 83% return of capital. So we were able to deliver the distributions in a very tax efficient way in 2024, and we hope to do so again in 2025.
Oh, okay. So I was referring to the last 19A form you guys filed in December showed 98% return of capital, but I didn't see the, what is it, the 8946. I didn't see the final form. I was looking for it, but my 98% was based on December's 19A.
Yeah, so 19As are very interesting. It's actually a good learning point that I learned through this process. 191As are sort of guidance, but they're not like the actual end all be all. And so the thing to look at is the 8935 that you mentioned. It should be available on our website. If it's not, I'll make sure to get it to you. And then, of course, the 1099 divs that you get for any of the investors that actually put resources in, that'll give you the final. I shared with you how the bank classified it, and that's what they pass on for the 1099 divs. 191As are really interesting because if you look at any income fund, there's sort of guidance, but a lot of times there's actually a really interesting reason for this. We did a blog post on it. One of the nuances of having an ETF is it's sort of stuck with these rules from the 1940 Act. One
Mhm.
of the rules is that long-term capital gains can only be distributed twice, maybe three times a year. So if you distribute something early in the year, you don't really know what its classification is going to be until end of year. So if you categorize it as like a long-term distribution and you do it more than two and a half, three times, you could lose your status as an ETF. So what a lot of ETF income providers do is they'll do a 191A and they'll categorize things as return of capital because that just gives you flexibility over time as things sort of fall into their actual tax classifications because you never know until actually like New Year's Eve of that year what categories things are going to be in. Return of capital gives you flexibility. So that's one of the reasons why you'll see a lot of rock in income distributions for a lot of income ETFs. It's because of the flexibility of it, but it's not necessarily how things will shake out after the year ends.
Is there any benefit to classifying it as like a qualified, like a long-term qualified dividend versus the return of capital?
If you can, if you can do that, like let's say you only, there's some ETFs out there that only do distributions twice a year. If you do that, you can basically true up middle of the year and just say, okay, I want to try and give the closest guess that I can give middle of the year, and then we can true up by the end of the year. It's basically that we want to give as close of like what the actual will be, but since we're distributing so frequently, it's hard to predict, and that's why you leave it in the rock bucket to keep flexibility.
That makes sense. That makes sense. Um, TSPY is doing zero calls to expiration. Before we started recording, you said you wanted to touch on something. You had you guys made some changes recently. Is that correct?
Yeah, it's one of the things, one of like the core values and things that's really important to us is as you experience and you get more data and information, how do you action that to be stronger? And so one of the things that we wanted to do 2 weeks ago was a really sort of interesting what they call tail risk event. So April 9th, if y'all remember, the market shot up as soon as the administration made an announcement about pausing tariffs for 90 days.
Mhm.
The market shot up 9.5% like immediately.
That was a good
And
day.
so yeah, it's a great day like for the underlying equities. For covered call strategies, that's the Achilles heel experience that you have. And the reason why is a covered call will set a strike. And if the market shoots through that strike, you cap the amount of the upside that you can collect.
Yeah.
So we did pretty well. I mean, I always want to do better. It was we captured about 60% of that upside that day.
Mhm.
Of course, I wanted to capture more, but with the strategy and where we were and the tools that we had, we captured about 60% of the upside. So with that, we wanted to say, okay, what tools can we put in place when the volatility is high to sort of prevent that kind of cap from happening in the future? So we went through and actually one of the things that is an interesting add is what's called a credit spread. So basically, you have a covered call and you sell your option at your strike, but you can actually buy another option that's further out of the money for cheaper. And they call it a credit spread because it's a net positive when you have both positions in place for the premiums you collect. So this is $3 hypothetically. This is $1 and you net $2. And if the market kind of does what it normally does, you net your $2, but you kind of buy that other call as insurance to fight against that upward rip. We didn't have that tool written into our prospectus. And if it's not on the prospectus, we can't use it. So since then, what we ended up doing was doing research on that and creating sort of tighter stop losses and things like that. But we updated our prospectus to add the ability to buy a long call.
So this
And
is
what
new.
that
This is brand new.
brand new. So that was April 9th. Today is the 22nd. So on April 18th, which was Friday, we got this new sticker put in. So go download it. It's on the website. It's at the top of the prospectus when you download it. And it just describes the new tools that we added. So we did that. And then on Monday, we updated all of our trading software over the weekend so that on Monday we had the ability to actually trade this. And then today, if you go look at TSPY's option positions, which we post on the website, you'll see two transactions. One's the short call, which is our standard cover call, but then you see a buy to open. That's the additional hedge that we have in case the market rips because maybe there's an unexpected announcement from the administration. That tool is really helpful to sort of cap the bad side of having a covered call because if things go way up, you don't want to have unlimited upside that you're not collecting. So this strategy really helps us do that, and we were able to quickly modify our prospectus, modify our trading tools, update all of our trading partners, and get the process and into place. And already on the 22nd, we put in our first long call trade into the market.
So it's similar to like a long synthetic. Is that what?
It's basically they call it a credit spread, is what they call it. So if you Google like credit spread, it'll kind of explain the idea that we have. But it's almost like think of I get lost in the terminology sometimes. Like a protective put.
Mhm.
Like if you buy a put, it protects the downside.
Yes.
This is the same thing. If you buy a call, it protects against the upside.
Yep. I was just talking to Howard Chan about that from Curve because they just started implementing that put to capture the downside to make that difference. That was actually one of my questions. I was going to ask you if you guys are going to implement that same strategy.
Yeah, it's such a great tool just to have in the toolbox. And then, one of the downsides of it is it costs money, right? When you actually buy a call.
Yeah.
So you're trading some of the dollars that you collect to buy it. So we'll probably implement it selectively and on days when volatility is high. You don't know if there's going to be another fast move. It's really nice to have that in as a safety net. So that's how we're going to start using it. And today's our first example of putting it into play.
Today it must be doing very well. Everything's kind of green.
Yeah, shockingly, yeah, it's doing great right now. And what's also nice, like the strikes earlier today, the market went through the strike, but you have less panic because even if it kept going up, we have a safety net. So that's one of the biggest things is it prevents what happened on April 9th from happening in the same way that it happened on April 9th. So that's our whole philosophy. What did you learn and what can you do better? That's one of the things we put in place.
The evolution of money. So should we expect a higher, and I don't want to hold you to this because this isn't financial advice. Everyone should know that you got to invest at your own risk, do due diligence. But should we expect maybe a higher dividend going forward if at least in volatile markets where you're able to capture that upside, should investors expect something higher than the 29 cents a month?
I think we're trying to deliver what the market's asking us for, and the market's been asking us for consistency. So our intention is to try and be as consistent as possible. It's ready for my bad analogy of the day. It's like peanut butter. You might get a big lump today, but you want to spread it evenly across the year so that people can plan their income and their lives on it. And so that's our goal is to be a consistent resource for investors over this volatile period.
Legacy. Any other funds that you plan on bringing out here recently? Anything you filed?
Yeah, so it's in the prospectus. Actually, we filed it originally with TSPY. We have a second fund called TDAC, which is the same strategy on the Qs. And our goal, we've kind of announced this before, But as soon as TSPY hits 50 million in AUM, then we'll get TDAC and launch that as well in the market. So we're excited to get to that point. We've had good momentum building AUM to this point, continue that momentum building, and then we'll have that second fund out in the market when TSPY hits 50.
So we're talking maybe by year's end.
Fingers crossed.
I mean, you already did 5x, obviously it's easier to go from 4.2 to 22 versus 22 to go to, 5x forward. Like that would be 200. That's a big leap, but you never know.
Never know. I mean, if we can double before the end of the year, then we'll be launching TDAC this year. So we're super excited. And I think that the coolest thing about it for me is like coming from a background as a tech entrepreneur and engineer, all the infrastructure that we've used and that we've been proving and like battle hardening with TSPY, all of it will be used to launch TDAC too. So all the lessons, all of the capabilities that we had for TSPY are also going to benefit TDAC investors when we launch that fund too.
So TDAC is going to be an exact replica of TSPY, same strategy, same distribution as well, or will you be able to capture more because the Qs trade at a slightly higher premium?
Yeah, we'll likely visit the distribution to see where we need to set that level, but the Qs have inherently higher volatility, so it's a reasonable assumption to say that we could potentially distribute more than the TSPY ETF.
And we're still not putting any puts in the prospectus.
So we did actually file the protective put in the prospectus, so it's there for both TSPY and TDAC as a tool in our toolbox. So we can use it, but we haven't yet, based on sort of it's one of those tools that we'll have on volatile environments, and we'll see if we need to put it in place to protect the downside. So we have it available if we need it.
This is great. By the way, I like your new background. The last couple videos I've seen, because I've been following the journey ever since 6 months ago.
Oh, awesome.
It's always been like the same office, so I like this one. This one, I like this. This is cool.
Yeah, so that one was like a virtual background that I had, and I got like unending flack for it. People were like, "Your clock isn't changing." I'm like, "It's a virtual background. This one's real though." So that's a win.
That's cool. I actually
Yeah.
thought it was. I didn't even realize it was a virtual background at the time, but
Oh, cool. All right.
I also
Canva
upgraded
did a good job.
so. um, so you have something going for the Qs. What I apologize. I forgot to look this up. What day do you generally pay on? What day does generally TSPY pay on?
Usually the first week of the month. So first Tuesday is declaration date, Wednesday is ex-div, and then the Thursday is pay date.
Any chance we can move that to Wednesday? I got a spot to fill.
In your distribution days, like you kind of stack it every day to get some?
So I started this actually right before I had you on, and I started kind of implementing this with Roundhill, where and I talked to them and I said, let's get a payday every Friday, and they were very agreeable to that, and we did that, and then I started with Howard at Curve, and I said, can we move? And this was back in, we tried to do it in December, but then it didn't happen until like February. I said, can we get paid every Thursday? And I'll explain why in a minute, in case you're not familiar with the content. We just had Vista shares on, Adam, and he moved his schedule to Tuesdays. So now we have Mondays and Wednesdays open. The reason for this is because if you're using E-Trade or Robinhood, right, when you guys send out your dividends from the transfer agent and they get distributed to all these funds like Schwab, Fidelity, they all pay first thing in the morning. The E-Trades and the Robinhood, which is probably your general audience that you're trying to look to attract, to be like millennials, Gen Z, they're not getting paid until after hours, Thursday or Friday morning, or sometimes Saturday, Monday. It doesn't fill their account. So they're actually missing out on that natural curve because of the brokerage they're using. So I'm trying to make and that's what people want, right? The Gen Z, the millennials, they don't want to work until they're 70. They want to live for the now. They're not looking to buy Costco and hopefully live for 6 years, until they're 78. And then they have a couple of, they don't want that. They want the income now. So I'm trying to figure out who's going to fill Wednesdays and Monday. What can you do?
Got it.
Can you
Interesting.
help us out?
So I understand basically because it's a day lag, um, if we distribute as we do, and we actually distribute on Thursdays, those folks won't receive their dividends until after hours Thursday, so they won't be able to take action until Friday.
Either after hours Thursday or like mid Friday. Yeah, if they're using Robinhood and E-Trade.
Got it. So then you would need someone to distribute on Tuesday, like payday Tuesday, to get the Wednesday block filled. Is that right?
That works, or Wednesday, and then they get it on. Then they get it on Thursday.
Got it. Okay.
Sometimes they have
Something to
like an
check.
actual. You know what I mean? That way they can use it as need be. A lot of these guys are, especially if they're using E-Trade or Robinhood. Some of them are actually living out of their margin accounts, right? They have like their debit card and they're actually living out of it, and that's how they're promoting. I don't know if you're familiar with the FIRE lifestyle,
Yeah.
the financial independence, retire early. A lot of these guys are, they're putting all their paychecks into their margin account, living out of it, right? They buy the dividends and then they live off the dividends. And so it really, for your audience that you're trying to capture, that's kind of where the headspace is.
Interesting. Okay, that's actually a good learning. One of the things I'll talk to the custodians, it's interesting to see the process for actually doing the distributions. So I will do research in it, no commitments at this point, but we'll see if it's doable. And the reason is, when they do the distribution pieces, like having it on a Tuesday to start, everybody's in the office, everybody's available to do it, and then the process can flow Tuesday, Wednesday, Thursday. But if we move it up to a Monday, making sure they can support it. If we had to pay on a Tuesday, though, we would have to do it on the Fridays, and with the vacation schedules, that creates, like holiday schedules. It's that type of stuff from an implementation perspective that makes it easier when you do it right in the middle of a week.
But you could do what? You could do declaration on Monday, X day Tuesday, pay Wednesday.
Potentially, yes. Let me
Okay.
let me talk to the custodians to see. Yeah,
Okay. I won't hold you to it. I'm just throwing it out there.
I love it. No, it's good. I just learned something. I didn't realize that the timing was what it was. So that's a really good thing to know.
Yeah, and for everyone, the unfortunately, like I like Schwab, right? But that's because I'm just like an old soul, I guess. But a lot of people don't like it because of the UI. Like the best user face, the user interface is on Robinhood. So everyone
Mhm.
goes to Robinhood, and when they're looking for, income supporting ETFs, like Robinhood doesn't do closed end funds. I don't know if you're familiar with that. So your only option, right, is to buy like limited partnerships or these income ETFs, and that's a massive audience that you're looking to capture.
Yeah, that's a really good learning to see. I didn't realize it was it was after hours for distributions because that's important. Like a lot of times too, especially, for folks that are taking part of their distributions as cash and then maybe reinvesting the other, you don't want there to be a gap. Let's say you want to recapture shares at a price that's close to where you got your distribution. The more time that lags, the more there could be a gap. So that's a really important note.
Yeah, like for me, like because I get them before market opens, the rest of the market runs up before Robinhood and E-Trade is they're buying it up here. The market's already run up.
Yeah, you're like, I just missed out on this. Come on, throw me a bone. It's my distribution. Like, let me put it to work.
Um, here's a good question for you. You guys are going to be generating a lot of premiums specifically in this market. It's crazy. What do you do with the extra premiums that you capture?
Yeah, it's a good question. So there's the peanut butter analogy. So we kind of keep it to spread it over time. But in the interim, what do you do with it? And so one of the things that we've talked about doing is actually taking maybe some extra premiums that we have and reinvesting it into SPY shares so that you can at least sort of capture the capital performance of SPY over time. But we're distributing 1.1, 1.2% per month. And so we've been pretty consistent on distributing what we've earned. But if there's extra, especially now, we hit our target distribution cash collection, I think less than halfway through the month because of the increased volatility. So right now we're holding it in cash through the rest of the month, and then after the month we'll We'll carve out the piece that's going to be distribution, and then the remainder will likely tuck back into SPY shares to continue that compounding.
So you're not, why not use the cash and buy treasuries?
We do. So the cash sits there right now. If you look at the holdings, we have treasuries
Okay.
as sort of the default. Yeah. So the default, like the cash sits, but the custodian automatically puts that in treasuries while it's sitting there.
Oh, all right, perfect.
Yeah.
That's what I want because obviously, like that has its own yield that it's
Yes.
accruing, which gets pushed on further down the road. Um, with the market being down, and I don't want to necessarily hold you to this. Do you think this is a good time for investors to start buying stocks and ETFs? Like you're buying a premium. In my opinion, you buy a premium discount now when the market's down so much that this forward momentum that we can experience as interest rates start coming down and we settle all the tariff crap, you know, that momentum will carry you forward. How do you feel about that? What do you think?
I So how do I couch this? For me and my risk profile, and a lot of the advisors I'm talking to as well, and again, you've got to manage your own personal situation. I look at it as everything's kind of on sale right now.
Mhm.
And so getting in now is a really good opportunity if you have a long view. If you have a long time horizon where markets are down a bit, you can actually capture things at a really, at a discount to what they were at the beginning of the year. For me, it's a good buying opportunity, and that's what we like to do. For others, though, that have a shorter time horizon, you've really got to think about where you put your assets. Because if you're a retiree and you need the capital, putting it at risk right now with a short time horizon is a different risk strategy. But for somebody like me who has a long time horizon, and advisors that I talk to too love these drawdowns for that reason alone. Like nobody likes the market to go down, but when it does, if you dollar cost average and you purchase consistently and you have a long time horizon, it's a really great way to create that compounding force that you need in your portfolio for the long term.
I've never understood that whole sentiment where you get one side where and they might be an older generation and they go, well, these tariffs sort of it's the president's fault, it's the Fed's fault, it's whatever's fault, it's my stock manager's fault, and they get very upset about the market falling. And I keep trying to remind people like everything's on discount. You've been waiting for this since 2020. Like
Mhm.
I've been waiting for. I'm implementing as much as I can. That like when people talk about the Great Depression, very few people go like, "Oh, my great grandparents lost everything." They go, "No, no, there was more millionaires created during the Great Depression than any other time in history, and now we're experiencing it again, and people are still complaining about it." I don't understand that. I can't wrap my head around it.
It's really interesting. I was reading a book recently about like brain science, super nerd weekend read. But one of the decision drivers in our brains is it's driven by emotion.
Yeah.
And one of the strongest emotions is fear. And fear is wired in, and that actually drives decisions. And so these markets stoke fear. You turn on the news, it stokes fear. Everyone's money in motion and everyone's freaking out. And that's what actually gets eyeballs because fear gets eyeball because of how we're wired. And so that's the thing where the lizard brain tells you, I'm scared, so I got to do something. But then if you stop for a second and you let your reason kick in, you say, wait a minute, let me think about it. Let me look historically at what's happened. And this actually could be a really great buying opportunity. And the smartest, most successful investors think that way to take advantage of opportunities that show themselves. And that's exactly how we like to think about the market. But there is a why behind it. It's just we've got to push through that emotional decision driver to get to the place that says, actually, if I think about this for a second, maybe I can come out of this stronger than how we went into it.
So, what do you think they should be doing? You think everything's on discount?
It's difficult for me to give advice because everybody's got their own individual circumstance. I can say for myself, who has a long time horizon, when you see market opportunities like this, and if I believe in the long term of the American market and the S&P 500, which I really do, and Warren Buffett believes in that too. for me, it makes sense to buy it because now it's at a 12% discount versus, 3 months ago when it was at a, closer to an all-time high. So for me, it makes a lot of sense. For individual investors, you've got to decide for yourself, but this is a really interesting time to be participating in the opportunities that are ahead of us.
I mean, even Rockefeller, right? When they filed antitrust laws against him, and he had to divest his companies into the seven holdings. When he sold off whatever shares he had, he actually made all of his money from dividends, and
Mm.
that's actually what made him, infamous. Further, I'm sure he would have been famous at, he's already rich, but like unbelievably rich was his compounding dividend growth after the antitrust laws.
That's a really interesting historical reference point too, in thinking about this type of investing. So that's actually one of the key drivers behind why we put TSPY together the way we did. We're balanced in our pursuit of capital growth and income. And the reason for that is over time, if that core nest egg continues to grow, guess what grows along with it? Your
Mhm.
income distributions. And so you get that compounding growth by actually having that versus some philosophies are if you basically take out all the distributions and spend it, that core nest egg can have NAV decay and go down. And why that can be potentially dangerous is because then your income over time will potentially go down proportionate to it. So for us, it's really important to stay balanced so that that nest egg over time has a chance to grow. And that's a really important piece when it comes to having consistent, sustained income that comes along with the fund.
I have seen other funds that are down, similar funds to TSPY. I'm not going to list any, but they're down. Some of them are down like 25% year to date. Not when I was looking last night, not this morning. Today, I don't know what it is today, but some of them were almost down 25% year to date. What makes TSPY different? Because you guys were not, I don't know, you weren't even close to that number.
I think two things. And was that number market price or was it total returns?
Market price.
Okay. Market price is interesting because it doesn't actually add the dividends in. So
Mhm.
the metric I love to use is total returns just to get apples to apples because different funds will distribute different things.
Sure.
So total returns for us, one of the things I think that makes T-SPY a little bit different is that we actually own real shares of SPY. Other funds use synthetics, and there's some really interesting considerations for that. But in owning real shares of SPY, one of the things that I learned in actually putting T-SPY together, at the end of a fiscal year, if you have a synthetic that's using index options to implement your underlying for your covered call, there's a rule that says you have to actually mark to market the value that's in that, even if you don't realize the gain. And if it's in an ETF, you're required to distribute 90% of it. So what
Mhm.
that means is like after end of year for the NAV, there's no way physically for the vehicle to have better than a 0% NAV growth. That's a huge challenge when you want your fund to be a long-term value store that compounds over time. We own real shares, so we don't have that limitation. So at the end of the year, even if we haven't realized any of those gains in SPY, we can carry that growth over to the next fiscal year and continue to grow over time. So that's one of the biggest differentiators is the under the hood construction of how we built TSPY.
I thought so. Are you saying that TSPY doesn't have to follow Act 40? It's an
We have
ETF.
to follow we have to follow the 40 Act, but because we own real shares, we don't have the same limitation of using index options for the poor man's covered call to build a synthetic. The synthetics are the ones that actually have that limitation within an ETF that makes them have to distribute the capital growth synthesized in the underlying. So if you ever look at synthetic ETFs and look at their December distributions,
They're
they're
massive.
always they're massive. That's part of the reason why they're massive.
Gotcha. Okay. Any advantage to that versus other than the carrying forward?
Carrying forwards one, and then tax benefit potentially. So since we are able to keep the value in the SPY shares, we never realize that gain. We just let it grow within those shares over time. It's tax efficient because you can carry that value forward. So I did two when I was constructing TSPY. I did the comparison. There's two scenarios. One, options premium and capital growth. The worst case is that they're taxed both at ordinary income and realized. Best case, we ended up finding a way to implement T-SPY where the option premiums themselves are 60/40 long-term capital gain, 40% short-term because of the index option. And then the underlying doesn't get taxed because we're not actually selling it and realizing the gain. So if you compare those two scenarios over 10 years and both funds perform identically from a total return perspective, what you're left with at the end of 10 years is 47% more after-tax capital by implementing it tax efficiently. That's a huge difference in choosing which way to implement it. If you're an income investor and you're not worried about capital growth and you just want short-term income, it doesn't really matter. But if you're a long-term investor where the growth side of it matters, how you implement it matters a lot. And that's one of the reasons why we built TSPY the way we built it. And it wasn't easy building it with real shares because of the full process that you have to put in place on the bank side. But we pushed through it for that reason, and that reason was a big driver.
But you can still only own 25% of the SPY is the underlier, isn't that right?
No, we own 100%. So dollar for dollar, if you look at SPY, it's 99 or 98, 99.5% SPY shares. And then the rest is just the cash that we're generating. So we basically dollar for dollar, you buy a share of T-SPY, it's almost the equivalent of owning a real share of SPY. And that's why we're able to also distribute dividends because we get all those dividends and give them to investors.
Which is also why it becomes super tax because you get the special tax benefit as well by owning the index.
Yeah, qualified dividend for the underlying, and then the index has 60/40 potential.
That's interesting. Okay. Well, I'll have to look back and look at the different. I'll have to do my own comparison
Yeah,
to
check it
see.
out.
Huh. Interesting. Okay. Is there anything else that we missed? What are we trading at today?
Let's see. T-SPY. So S&P right now is at 52.46. Our strike price is at 52.90. So we have still a good, I coined this term, I'm very proud of it. I call it my strike halo. So we still have a strong strike halo between where the market is and where our strike is. And then further out of the money, we bought a long call at 53.35. So if like there was a tweet from the administration and it went up to like 5,600, we'd be capped on how that would impact the option position.
Why do you call it Halo?
It's just kind of a safety zone. So it's the strike halo. It's the safety zone between the market and where our strike sits.
Can I give you a better story? Because that sounds terrible.
Okay, give it to
Halo is
me.
the acronym for Special Forces High Altitude Low Opening.
Uh,
That sounds more appropriate for what you're aiming to do, right? It's a high altitude, like you're like out of the money.
oh, I love it.
High altitude low opening.
I'm gonna write that down. See, the other resource that works with VP of operations, he was a ex-Navy helicopter pilot,
Oh,
and I'm
cool.
like, come on, give me the acronym. So anyway, I'll have to give him some flack on that because he didn't give me the watch out for that. But that's way cooler.
I only know it because my uncle is a colonel in the Marine Corps and he did also special forces and stuff like that. It's the only reason I know that.
I love it. That's great.
It looks like you guys are up 2.22%, 2116. Is that accurate? That might be delayed.
Little delayed. 2108 right now is what I'm seeing, about 1.84% right now.
What do you feel about the tariffs? What's your take on this whole tariff thing? Are we recessionary? Are we going to experience some temporary inflation and then come down? What do you think?
I think once we get clarity, I think the biggest thing, so you saw the market rip on April 9th because the president paused tariffs for 90 days. I think in this 90-day period, we need to get rock solid on what the policies are going to be and for what countries. And once that gets set, I think it's going to open things up in quite a positive way for the market because right now things have been, yesterday's downtrend of 2.5% comes from that uncertainty. So I think that's a key thing. And then, in the interim, depending on where those tariffs land, they're just based on the economics of it, there's inflationary impacts. Hopefully they're short term and things will settle out. But the biggest thing I think that the market is begging for right now is certainty. And you can see it. I mean, I'm looking at it right now. So like one of the things that I started watching every day is the VIX. And you're like, what does the number mean? When I first started trading 0 day options, the number was 12 to 14. When we launched the fund, it was maybe 16 or 18. For the last week, the VIX has been over 30. Okay, that's a big marker for the VIX. And the day, April 9th, when things shot up, you felt it. Like you could feel the uncertainty in the air. And the VIX was over 50.
Mhm.
So that day, we used the extra option premium. We set our strike halo, way cooler the way you said it. We set it at 5.25%. We'd never set it near that high in the history of the fund. Normally it's whatever. If it's a lower VIX, like 0.5%, 1%, 1.5. But we're like, okay, it's never happened before a 5.5% jump or 5.25. So we set it there. And then the thing happened and it went 9.5. That's statistically, like if you look at a bell curve, it's impossible. It never happens. But that's why they call them what they call them. They call them tail events. I'm like, why do you call it a tail event? And the reason is if you look at a bell curve, the two ends, they kind of look like animal tails.
Yeah.
Those are the tails. And so this was an upside tail event. Statistically, it's never supposed to happen, but it sometimes does. So for us, we're like, oh, we don't have a protection against this tail event, but this happened. This was the third biggest jump since World War II. It hadn't happened in 16 years. The last time was 16 years ago. So you're like, okay, it's very unlikely that it's going to happen until it does. And so now that the markets are kind of volatile, we're like, okay, we need to plug that hole and make sure that we have a protection against it. And that's why we made the changes to the prospectus. So I think in the immediate term, volatility, you see it is still up. When the VIX is over 30, you know the market's asking for certainty. That's the number I always continue to watch to make sure we're managing risk the right way.
And if anyone watching this wants to go look at the actual definition, it's called lipokurtosis. That's the tail end where you have these like
Love it.
crazy like bell curve shit. Some of them underperform, right? Some of them hit just where you want like a natural move. But lipokurtosis is like these crazy swings, and you get these, like you said, like the tails at the very end.
Mhm.
So if anyone wants to actually go look that up, you guys can find the Google diagram so you can better understand it. I don't think,
Really helpful.
yeah, if you look up tail ends, you're gonna get like a bunch of dogs wagging or something.
Yeah,
It's
don't
not
don't Google that. Don't Google that.
um, how do you feel about Jerome? What do you think? We got, what is it, May 7th is the next FOMC meeting? Do you think what's your bet that he's going to drop interest rates?
Man, that's the billion-dollar question. He's in a tough spot. He's in a very tough spot because he's got the dual mandate. And right now, the dual mandate, if you move the market interest rates, it hurts one to benefit the other.
Mhm.
So, it's basically the stagflation like quandary. That's where we are right now. And so I think my bet is that he's going to hold pat because he doesn't want to hurt one versus the other. And he's very data driven and he's slow. That's my guess. But now you see all the political pressure. And I think, one of the reasons why the market's kind of up a little bit today, at least this is what the media is saying, right? They said yesterday it was down because there was more pressure to fire Powell. But what the reality is, there's a committee, FOMC. So in order to actually get the outcome that the administration wants, which is lower rates, the whole committee has to turn over. And that's a lot heavier lift. And so people realizing that today are like, oh, okay, well, we have at least a structure in place that allows for some stability. And that's what the market really wants. And so I think we saw some comeback when that reality came to pass. So I think Powell's in a tough spot. I without taking a position on him, the thing I like about him as a compliment to what the administration has been doing is just a steady hand. We just need calm and steady to steady the markets, and he's been a good counterbalance. And hopefully the administration will get there too, get some deals done with countries that have really well-defined tariff policies that will be the model for all the other countries to follow suit. I think it'll be dominoes, but you just got to get the first few done to set the model so that the rest of the world will follow. And then I think we'll get to a better place. But right now, watch that VIX. Over 30, the spidey senses go up.
Yeah, everything falls.
That's what we're seeing.
Is there any time that, because I just started, really following the VIX, is there any time when the VIX is up, but the market's also going up?
It's rare. A lot of times VIX, you'll see the VIX correlate with market falls because it's the fear indicator.
Yeah,
It's technically volatility, so upward volatility still contributes to it, but the biggest impacts are when markets are down, you see the VIX spike.
because they're, but it's controlled by the 30-day call and put options is the VIX.
Yeah, and that's built in standard deviations and and actually the call and put options pricing is driven by the volatility of the movements. And so that's the thing. Movements up and down, absolute value contribute to VIX, but you see the bigger impacts when markets move down that the VIX actually goes up.
You actually just gave me a kind of a question you might be able to answer. You said it's based on the it's is it based on the nominal? So say you're implementing all these strategies, right? And you're trying to capture, you as an ETF fund trying to capture income. You're doing the far out calls, the at the money calls, 5% of the money, but then you're also implementing a put strategy. Is all of that nominal value also being attributed? Well, I guess your zero data expiration wouldn't be because that wouldn't imply on the VIX, but the other two might, if they're far out, would that nominal value get carried over to the VIX?
Yeah, basically the pricing that you see in the options market is two things. It's formulaic plus market demand. You put those two things together, and that's what you see in the options market. And those things are driven by the volatility, the standard deviation of what we're seeing in the VIX. And so that those things tie together in a close way where when you just looking at the VIX over 30 and you set a marker, 5% out of the or call it a 25 delta call. Your 25 delta call on a 30 VIX day, the premium is going to be, it's either large or it's going to have a big difference between where the underlying market is. So you see it reflected directly proportionally in option premiums. So that's why VIX is a really good one to look at, especially if you're banking on option premiums to be the thing that's collected and converted into income.
But I mean, so maybe I didn't word this correctly. As more income managers are placing these puts on their funds, does that push the VIX more towards the fear? Like as investment, like you guys have so much capital that you're implementing, is that also adding to these giant swings?
Oh, I see what you're saying. Yeah, does that actually drive the underlying swing?
Because there's so many funds doing it. There might be 15 funds that have a couple $1 billion in management, and you guys are all writing options. Are we going into this sentiment where we've basically artificially created a meme, right, of the entire market where we're just swinging back and forth because of the options premiums being placed because we all want income?
That's a great question. That's actually one of the theories of maybe why April 9th happened to the extreme that it did. The answer, well, my short answer is I don't know. But the real driver of that isn't the volume of the options market, it's the balance of it. So if you have buys and sells and puts and calls that are out of balance, that's when you start to see swings kind of go in one direction or another. And to answer the question, SIBO, the exchange has all of the data on zero dated options and longer dated options where you can see volumes, premiums, and performance. And the thing that they've seen and why they're like zero dated options on indexes are okay, they're safe-ish, even though retail is driving a lot of it, is because all of the volumes are in balance. But the thing to go check the data on, and I'm going to do this after this call, is to see are there periods where they're out of balance. And that's when you can get the underlying impacts that you're talking about because there's people stacking on one side of the equation versus the other. So that's a really good watch out. I don't know the answer, but I know where to find it.
Yeah, it would just be interesting if you have, you know, I don't. I'm going to use you for an example. If you guys are going, all right, we're going to write 25 billion, 5% in the money puts over here, and then 25 billion out of the money by 10% over here. Is there a massive swing imbalance because we're operating at such large numbers, right? Because they're all you guys, we're all doing it, right? Retail traders, fund managers, everyone's doing it. We're like, Trump posted something today that he might be thinking of some. You know what I mean? We have this massive swing
Yeah.
one because we're all kind of in this together now, right? We're all chasing
Yeah.
the same thing. That it's become
And
like it's super volatile. I have a feeling this might be around for a while. I don't think it's going to be a 90-day. I thought it might steady off. I have a feeling that we're gonna have this for a while.
yeah, you might be spot on. And I mean, time will tell. Can't predict it, but just having the right tools in place, I think, is the most important thing. And having the right rules on how to use those tools will help us kind of navigate through it. At least that's what we're banking on. And so that's why we make the changes that we make. But you raise a good point where if it is out of balance, like you take one position up and one position down, but there's always someone on the other side of the trade, whether it's a market maker or actually another party. So for us today, for example, we put that long kind of insurance call on, but somebody else is making a premium off of it, and I'm willing to pay it because it's insurance for me in case things go against us. So there's different strategies that are people are implementing that actually have been contributing to the balance. It's just if everybody's on one side and of one mind trying to hedge one way, that's when markets could get into trouble, but the data will tell us the truth.
I have this weird suspicion. We'll have to check back in 6 months around Christmas time. I have this weird suspicion that we're going to be reaching more of those tail ends a lot more free. Money's evolving, right? We have like
Hmm.
0 days to expiration was never a thing up until a couple of years ago.
Yeah.
Income investing and a taxable brokerage with and we're all doing it on our phones all day. That was never a thing up until recently. And
Yeah.
now people are becoming hip to it, right? I think we're going to see a lot more. That might be the new standard going forward. I don't think it's going to be you know, used to be what 10% was the average forever that the S&P recovered. I don't think that's going to be the standard anymore. I think it's going to be more like TSPY, their average, return is 15% or 27. It's going to be crazy outlier markets.
Let's put that. So I'm going to mark this date on my calendar, and then 6 months from now, when we talk again, let's actually do that analysis and see where things shook out. I love it.
Yeah, I think that's awesome. Go back to 2024. That's my last question for you. Is there anything you would have done differently in retrospect?
2024, key things to do differently in retrospect. Yes, there were several things to do different in retrospect. And I apologize. I have a meeting in 1 minute, so got to
Right.
keep it super brief. But one of the things was like the way that our NAV is calculated, understanding that more from an ETF perspective was a learning experience. And the biggest thing that I learned is that actually like there's a delay in the cash recognition of how trades impact your NAV. So having known that, now we have some processes in place to make sure that we can tighten up when there's a market event to when it actually gets reflected in NAV. So April 9th is a good example. There was a 1 day delay between the actual market event and how it was reflected. So it looked like at the end of Wednesday that we captured all 9.5% of the upside, but we didn't. And it didn't show up until the next day. And so people were like, oh, it's great. And then they're like, why is there a big loss? It's just because the timing was off. So things like that, I think from a mechanics perspective, are really interesting. From a strategy perspective, it's always going to be this way. We're never going to be able to foresee all of the scenarios. But as long as we keep a growth mindset, learn from it, take the data, and then adjust our processes once we get more of that over time, we're going to get stronger and stronger and stronger over time. And that's the lesson I learned since we started this fund to today, and all of those things have been put into our technology, our processes. But the big idea is, hey, we want to be better today than we were yesterday, and the markets will test you every day, and we're trying to get stronger and stronger over time.
So I thank you so much. We'll see you at 50 million, 6 months. I'm counting on it. Let's go. I know you have to step off, but we'll see you next time. Thank you so much.
Thanks so much for having me. Looking forward to it.
Take care.
Bye bye.